I clearly remember when the government launched sovereign gold bond in 2015. It was honestly one of the smartest financial products the Indian government has ever introduced for gold investors. The idea was brilliant. Indians love gold and we import huge quantities every year. That hurts the current account deficit. And government wanted to reduce this current account deficit. So instead of people buying physical gold, government said, hey, don't buy gold. Buy a bond linked to gold. You get the same price benefit but without importing the actual metal. And the product design was extremely attractive. You get 100% sovereign guarantee since it was backed by the Indian government. Plus you get gold price appreciation plus and sweet 2.5% additional annual interest paid in cash. And if you held the sovereign gold bond till maturity, capital gains were tax free. At that point in time, compared to physical gold, gold ETF or gold mutual fund, sovereign gold bond looked like a no-brainer. Same gold return, extra interest, zero storage cost, zero tax at maturity. For long-term gold allocation, this was arguably the best gold product ever created in India. And for a few years, it worked beautifully because gold prices were stable and issuance volumes were small. But structurally, sovereign gold bond had a fatal flaw. Unlike gold ETF or gold mutual fund, sovereign gold bond were not backed by physical gold. So when a gold ETF or gold mutual fund issues unit, it buys actual gold and store it in the vault. So if gold price rise, the value of underlying asset in the vault also rise. So there is no financial stress on the issuer. In sovereign gold bond, the government did not buy gold. It simply promised, whenever you pay, we will pay you the rupee value of gold at that time. Now this was manageable when gold moved slowly. But when gold price moved crazily, it became a big financial blunder. Let's take an example to understand this blunder properly. So in 2016, suppose the government issued an sovereign gold bond when gold was 30,000 rupees per 10 gram. And let's say you bought it. Fast forward today, gold is around 1.5 lakh rupee per 10 gram. It means at maturity, the government has to pay 1.5 lakh rupee in cash even though it never bought gold at 30,000 rupee. So the entire price risk of gold sat with the government. There was no gold asset rising in value on the other side. It means every 10,000 rupee rise in gold price meant 10,000 extra payout from government's pocket. Just to give you a perspective with real numbers, between 2015 and 24, the government issued around 147 tons of sovereign gold bond. At issuance, the average gold price was roughly around 25 to 30,000 rupee per 10 gram. Today, the same gold is trading at 1.4 to 1.5 lakh rupee and the government has approximately 125 tons of gold outstanding in sovereign gold bond. That means the redemption value of sovereign gold bond has gone up 4 to 5 times from initial issuance, so the government must pay this difference in cash, plus 2.5% interest every year on top of that. Mind you, this 2.5% interest was coming from taxpayers' money. And rough estimate put the total outstanding sovereign gold bond liability at well over 1.9 lakh crore in today's term. Of course, this number keeps changing with gold prices. But needless to say, this liability of 1.9 lakh crore would be paid from taxpayers' money. So every time gold hits a new high, it is not just good news for investors, it is a direct fiscal headache for the government. So basically, three things went wrong simultaneously for sovereign gold bond. First, gold prices exploded far more than government expected. I mean, while designing the sovereign gold bond scheme, no one in their wildest dream would have imagined gold jumping from 30,000 rupee to 1.5 lakh in next 10 years. Second, there was no physical backing or hedging mechanism. If the government had backed the sovereign gold bond with physical gold or derivatives, the damage would have been contained. Third, sovereign gold bond did not meaningfully reduce the gold import. See, the initial idea to launch sovereign gold bond was to reduce the import of gold to contain the fiscal deficit. But Indians continued to buy jewelry and physical gold anyway. So the government ended up with high fiscal liability, no import reduction, and rising interest payment. In hindsight, sovereign gold bond solved none of the macro problem but created a massive new one. This is why government has quietly discontinued new sovereign gold bond issuance. There's been no official press conference admitting the failure, but there have been no new tranches announced. That silence itself tells the story. Please note that the existing sovereign gold bonds will be honored because sovereign credibility matters, but the scheme as a policy tool is effectively dead. And in latest budget 26, government has introduced taxation on sovereign gold bond. Earlier, all sovereign gold bond enjoyed tax-free capital gain at maturity, even those who bought from the secondary market. Just to simplify this, if you held a sovereign gold bond till maturity, that is 8 years, capital gains were completely tax-free. It did not matter how you bought it, whether you subscribed directly when the government issued it or you bought it later from the stock exchange, that is secondary market. But now the government has narrowed this tax benefit. If you bought the sovereign gold bond directly from the government at the time of issue and hold it till maturity, the old benefit would continue. So your capital gain at redemption are still tax-free. But if you bought the same sovereign gold bond later from the stock exchange, even if you hold it till maturity, capital gains will now be taxed as per long-term capital gain rules, that is 12.5% without indexation. So basically government is now trying to control the damage, but the damage is already done. In fact, it shows the ugly side of this government decision. This taxation shows how government can change any tax in the future. For instance, today pension funds are tax-free. Maybe government can make it taxable in future. So today if you are investing in government financial products that are currently tax-free, you can't be sure that the same product will remain tax-free in the next 5, 10, 20 years. So yeah, sovereign gold bonds started as a brilliant idea. For investors, they have delivered phenomenal returns. But for the government, they became an unhedged bet on gold prices. And that bet went badly wrong. In fact, sovereign gold bonds are a classic example of how a product can be excellent for investors yet disastrous for the issuer if risk is mispriced and unhedged. The lesson here is not just about gold. It's about how financial engineering without balance sheet discipline can eventually blows up. Now, I'd love to know your take on sovereign gold bond. Do you think it was a wise decision to launch it? If you find this video useful, do share it within your circle. I'll see you in the next video. Till then, take care.